We are jumping straight into a pretty wild financial paradox today.
Yeah, paradox is definitely the right word for this one.
Right. So we are looking at Booz Allen Hamilton, ticker symbol BAH, and they just released their Q4 2026 earnings. And honestly, the numbers present this fascinating contradiction.
I mean, it really breaks the traditional rules, right?
Exactly. Because usually when you're a retail investor evaluating a corporate earnings report, you rely on basic financial physics. A company sells more products or services, they bring in more top-line revenue, and therefore they generate more bottom-line profit.
Right. The math is supposed to be totally linear. It's supposed to be straightforward.
But today we are looking at this massive government contracting giant where that fundamental physics engine appears to be running completely in reverse.
It's running backward. I mean, the initial reaction from anyone just scanning the headline data is pure confusion.
Yeah, because they reported a year of shrinking revenues, right?
Yeah.
But somehow their profits actually exceeded expectations.
Which makes no sense under the traditional model, because that model dictates that a contracting firm grows by, expanding its footprint, winning more contracts, hiring more bodies, billing more hours.
Right, the old Beltway bandit model.
Exactly. So when that footprint shrinks, the profits are supposed to shrink right along with it. But what we are seeing in this specific transcript is it's a structural decoupling of revenue from profit.
Because of what they're actually selling now, right?
Yes, it's driven by a radical shift in their core product offering.
Which makes this the perfect subject for this special Talk Tickers deep dive. Our mission today is to cut through all the dense Wall Street jargon, bypass the polished corporate speak, and figure out exactly what is happening inside Booz Allen Hamilton.
And we really need to dig into the mechanics of this, because if you're managing your own portfolio, this is tricky.
Right. For those of you tracking the defense sector, we are taking a distinctly data-forward approach today. We're going to unpack the headline numbers, explore the crazy tech story driving those numbers, look at management's pretty cautious guidance, and deliver a verdict on whether this stock is a buy, a hold, or a sell.
The stakes here are high, too. I mean, the whole defense sector is undergoing this massive procurement shift right now.
Yeah, how the government actually buys things is changing.
Totally. And investors who only look at the top-line revenue, they're going to completely misprice the companies that are actually navigating this transition well.
Well, let's start by throwing the raw data on the table, because the initial shock value is definitely there.
Oh, absolutely.
I am looking at the Q4 2026 top-line figures, and gross revenue for the fourth quarter came in at $2.8 billion.
Right.
Which represents a 6.4% drop year over year.
Right, a fairly significant haircut.
And if you strip out the billable expenses, the revenue is actually down approximately 7%. And the thing is, this isn't just a single quarter blip.
No, it's the whole year.
Right. Zooming out to the full fiscal year, gross revenue was $11.2 billion, which also marks a year-over-year decline. So for a business of this scale, deeply entrenched in the federal government ecosystem, posting a nearly 7% quarterly decline, that's a massive flashing indicator that the core machine is slowing down.
Normally, yeah. I mean, a top-line contraction of that magnitude in the government services sector typically triggers panic selling.
Because everyone assumes the worst.
Exactly. The immediate assumption is the company is losing recompetes, or they're failing to win new bids, or they're just getting crushed by federal budget cuts.
But the stock didn't crater.
No. And the broader market's reaction to this report requires us to look further down the income statement. And
that is where the paradox really solidifies. Because despite that shrinking revenue pie, their Q4 adjusted earnings per share, the EPS actually jumped 11% to $1.78.
It's incredible.
Full year adjusted EPS hit a robust $6.51. And then when we look at adjusted EBITDA, it hit $309 million for the fourth quarter alone.
Which is a huge number, but we should probably pause and define adjusted EBITDA real quick for anyone new to evaluating these capital-intensive service companies.
Good call.
It stands for earnings before interest, taxes, depreciation, and amortization. It basically functions as the purest lens into the core operating cash flow of the business.
Because it strips away all the accounting noise?
Exactly. You strip away the tax environment, the interest payments on their debt, and the non-cash accounting charges like depreciation, and you are just left with the raw cash profitability of the actual operations.
Right. So generating $309 million in a single quarter while revenue is actively contracting, that tells us the efficiency of the underlying operations has improved dramatically.
Yes. But the absolute dollar figure isn't even the most critical data point here.
It's the margins.
It is entirely about the margins. That's the metric that dictates the valuation multiple.
I have that exact figure highlighted right here. Q4 margins expanded by 50 basis points, landing at 11.1%.
The huge jump for a contractor.
And for the full fiscal year, they delivered an adjusted EBITDA margin of 11% on $1.2 billion of total adjusted EBITDA.
Now, when we say margins expanded by 50 basis points, I know it can sound like, minor accounting trivia.
Yeah, it sounds like Wall Street jargon. Let me frame this with an analogy that I think translates to the structural reality of the business.
Go for it.
Think of a massive traditional law firm. Historically, this firm makes its money by putting like 500 paralegals in a room to read boxes of documents.
Right, the old bill by the hour grind.
Exactly.
Yeah.
They bill the client by the hour for every single one of those paralegals.
Yeah.
So the revenue, the top line is massive because they're billing thousands of hours. But their margins are actually super thin because they have to pay salaries, healthcare, benefits, overhead for 500 people.
Okay, I see where you're going with this.
So then that same law firm develops a proprietary artificial intelligence system that can review all those exact same documents in 10 seconds.
Right.
They fire 400 paralegals. They charge the client a fixed flat fee for the document review. Now, that flat fee might be less than the total hourly bill used to be, meaning the firm's gross revenue actually goes down.
The top line shrinks.
The top line shrinks, but the software costs almost nothing to run. So they get to keep almost all of that flat fee as pure profit. Their margins explode. They're suddenly making more actual cash while billing less total revenue.
That is a perfect analogy. The transition you just described is literally identical to the transformation Booz Allen Hamilton is executing right now.
It's wild to see it in the actual data.
It really is. I mean, the CEO, Horacio Rosansky, characterized fiscal year 2026 as the, quote, most challenging year we faced as a public company due to these unprecedented headwinds.
But they still beat on profit.
Exactly. He noted that profitability exceeded revised expectations, specifically because of what he called exceptional cost discipline and a pedal-to-the-metal approach to their strategic transformation.
They're ripping the Band-Aid off.
They are. They're actively shedding those low-margin, labor-intensive contracts to focus on highly specialized, high-margin technology deployments.
And you can actually see the proof of that transformation buried in the Q&A session of the transcript. An analyst asks a really direct question about headcount.
Oh, yeah, I saw that.
Booz Allen's headcount was down 12% in the quarter. They operated with 12% fewer human employees, yet their revenue generated per employee increased by 6%.
That is the whole story right there.
They are systematically purging the low-margin body shop labor and keeping the high-value software engineers and AI specialists.
Because historically, that entire Beltway Bandit business model was predicated on being a body shop.
Yeah.
If the Department of Defense needed intelligence analysts, Booz Allen would hire them, add a tiny percentage markup to their hourly rate, and lease them to the government.
And the only way to grow profits in that old model is to just relentlessly hire more bodies.
Right. It is a highly commoditized, low-margin grind. But by shifting away from that, they're fundamentally rewiring the financial DNA of the corporation.
But, to fully grasp this earnings report, you can't just treat the company as a single entity, right?
Definitely not. The COO, Christine Martin Anderson, explicitly described their current environment as a heavily bifurcated market.
Bifurcated is the key word.
Yeah.
We're basically looking at two entirely different businesses operating under one corporate roof, moving in radically opposite directions.
It's a tale of two markets.
Let's start by examining the anchor that dragged that top-line revenue down by 6.4%. We need to look at the civil business portfolio.
Right. The civilian side.
This division handles domestic agencies, so Health and Human Services, the Department of Homeland Security, the Treasury, the IRS. In Q4, civil revenue did not just dip, it plunged 23% year over year.
Just brutal.
Yeah, a 23% drop in a core division requires a real forensic breakdown. What happened there?
Well, management attributed this massive decline primarily to tough comps, specifically citing the roll-off of a massive legacy contract known as PTEMS.
PTEMS. Okay, what exactly is a roll-off for the folks listening?
So, in government contracting, a roll-off happens when a long-term, high-value contract reaches the very end of its performance period. The work is done.
The contract just naturally expires.
Exactly. And if a firm does not immediately secure a replacement contract of equal or greater value to fill that hole, it creates a massive vacuum in the year-over-year revenue comparisons.
Right, because last year you were booking millions from it, and this year it's a zero.
Bingo. And PTEMS was a colossal, labor-intensive integration contract. When the billing for that work stopped, the top-line civil revenue just cratered.
But it wasn't just PTEMS, right? The transcript indicates they faced run rate reductions across other civil contracts too, specifically mentioning reductions at the Treasury Department.
Yes.
And this brings up a pretty delicate issue that an analyst confronted management with directly during the call. There have been previously disclosed reputational issues regarding Booz Allen's work with the IRS.
Yeah, that was a tense moment on the call.
Because for a retail investor evaluating the safety of this stock, the idea of a contractor being, blacklisted or disadvantaged by a major federal agency, that is a massive red flag.
The analyst essentially asked if this friction was actively preventing Booz Allen from successfully pursuing new bids.
And how did management handle that?
The COO managed the question very carefully. She emphasized that they remain in close contact with their customers and rely on letting their, quote, work speak for itself.
Which is classic corporate PR speak.
Totally. But she did acknowledge the reductions at Treasury, and she stated they are actively looking for opportunities to turn the page.
So if we translate that from executive speak, she's basically acknowledging the damage. They took a tangible financial hit due to client friction. They are attempting to repair the relationship, but the bleeding on those specific accounts is clearly evident in that 23% plunge.
Yeah, you can't hide a 23% drop. But furthermore, the broader civil market is fundamentally changing how it purchases services right now. The transcript details that while the raw volume of new contract awards in the civil sector remains high, the actual structure of those contracts is shrinking.
Shrinking in duration or dollar value?
Both. When a massive 5-year, $100 million legacy contract expires, agencies are not replacing it with another massive monolith anymore. They are issuing smaller, piecemeal recompetes with much shorter periods of performance. So instead of one $100 million deal, it's maybe a 1-year, $20 million contract.
And it takes a monumental effort to win enough of those smaller, fractured contracts to fill the huge revenue hole left by a legacy behemoth rolling off.
Exactly. It's a logistical nightmare.
Add to that the macro-political environment. Right. I mean, Congress spent a huge portion of the last year operating under continuing resolutions.
The dreaded CRs.
Right. Short-term funding bills that essentially freeze government spending at the previous year's levels and legally prevent agencies from starting any new programs.
Which is devastating for contractors. If civil agencies cannot legally start new projects, contractors cannot win new work to offset their expiring contracts.
So you have the combination of the PTEMS roll-off, the Treasury reductions, smaller contract scopes, and congressional budget freezes. It created a perfect storm for the civil portfolio.
It really is the anchor dragging the top line into negative territory.
But the reason the stock didn't collapse, and the reason profits actually soared, is because of the sheer power of the company's other half.
Right, the engine of the operation.
The national security portfolio. This encompasses their work with the Department of Defense, the intelligence community, and space-based defense architecture.
The really high-end stuff.
Exactly. And while the civil side was plunging 23%, national security managed to grow 1.6% in Q4.
Now, on a percentage basis, 1.6% sounds pretty anemic.
It does. But the raw dollar scale changes the perspective completely. That marginal growth allowed them to secure a staggering $1.7 billion in new contract work in a single quarter.
For national security alone.
Right. $1.7 billion in new work in 3 months.
And the profitability of that $1.7 billion is what drove that 50 basis point margin expansion we talked about earlier.
So to understand why this work is so much more profitable, we really have to look at the specific technology Booz Allen is deploying here.
Yeah, the CEO framed this against a macro backdrop of intensifying global geopolitical competition. The U.S. military is no longer looking to hire thousands of administrative clerks. They are urgently seeking technological superiority to counter advanced adversaries.
And the specific phrase that completely dominates this transcript is agentic AI.
Agentic AI. This is a critical technical distinction that investors need to master right now.
Because we hear the term generative AI constantly.
All the time.
Chatbots, image generators, large language models that write code. But generative AI is essentially just a highly advanced digital assistant.
Exactly. It waits for a human prompt, it generates a response, and then it waits again.
It requires constant human intervention and oversight. But the Pentagon doesn't just want a smarter chatbot. They want agentic AI. How is that different?
Well, agentic AI represents a leap from a passive tool to an autonomous operator. An agentic artificial intelligence is literally designed to act as an independent agent.
So it does things on its own.
Right. You give it an overarching goal, and it is capable of continuously observing its environment, formulating a strategy, and executing complex, multi-step decisions to achieve that goal without a human sitting at a keyboard approving every single action.
That's wild. And the transcript specifically details how Booz Allen is applying this agentic AI to cyber defense through a proprietary product suite called VELO.
VELO.
Yeah. They aren't just selling advice on how to secure a network anymore. They were deploying autonomous software that actively hunts threats.
And the COO mentioned a fascinating detail about that. They actively emulated advanced AI-enabled cyber attacks during the first quarter to better understand the threat landscape.
Meaning they built their own AI hackers to attack themselves?
Essentially, yes. They are building robotic sparring partners to train their defense systems.
Wow.
And the necessity of that approach just comes down to the speed of modern warfare. State-sponsored hackers are increasingly using AI to automate their attacks.
And human reflexes just can't keep up.
They can't. When a cyber attack occurs at machine speed, a human analyst staring at a monitor cannot physically click a mouse fast enough to identify the anomaly, trace the origin, and quarantine the infected server before the network is entirely compromised.
So the defense must also operate at machine speed.
Precisely.
They are using this agentic AI to automate what the industry calls the cyber kill chain.
Which is quite a phrase.
I know, it sounds incredibly aggressive for a software discussion.
Genuine.
What exactly is a cyber kill chain?
So the cyber kill chain is the universally recognized framework that outlines the distinct stages of a cyber attack.
Okay.
It moves from initial reconnaissance to weaponization, delivery, exploitation, installation, command and control, and finally, actions on the objective.
Like stealing the data or deploying ransomware.
Right. And historically, you would have human analysts trying to manually detect activity at each of those stages. But Booz Allen's VLOG suite is designed to deploy agentic AI to autonomously detect and literally sever that chain the exact millisecond an anomaly is recognized.
Operating within a zero-trust architecture. That was another phrase that came up a lot.
Zero trust is absolutely vital to understanding these high-margin contracts.
Because the old model of cybersecurity was basically the castle and moat approach, right?
Exactly. You build a massive firewall, the moat, around the corporate or military network. And if an employee logs in, they cross the drawbridge, and the system assumes they are trusted.
Right. Once you're in the castle, you can access almost any room.
But the failure of that model is catastrophic if an adversary manages to steal just one employee's login credentials.
Because then they just cross the moat disguised as an insider and have total free reign.
Yeah. So zero trust architecture completely flips that assumption. It assumes the network is perpetually breached and constantly hostile. In a zero trust model, crossing the moat grants you absolutely nothing. Every single room, every single file cabinet inside the castle has a separate biometric lock.
The system constantly demands verification.
Constantly. Identity, device health, authorization for every single microtransaction.
And implementing a true zero-trust architecture across the labyrinthine networks of the federal government, I mean, that is an incredibly complex engineering challenge.
Oh, it's a massive undertaking.
And that complexity is exactly what allows Booz Allen to charge a premium. Furthermore, they are taking this proprietary agentic cyber tech and they're aggressively pushing it into the commercial sector as well.
Which is a huge shift.
Right. The transcript notes they acquired a company called DeFi Security specifically to scale their product sales. They are actively shifting from a pure labor consulting model to a software as a service or SaaS model.
And SaaS models inherently command vastly higher valuation multiples from Wall Street.
Because the margins are structurally superior. You build the software once and you can sell it 1,000 times with near zero marginal cost.
Exactly. And the acquisition of DeFi Security demonstrates management's impatience here. They are unwilling to wait years to organically build a commercial sales pipeline from scratch.
They just bought their way in to accelerate the deployment.
Yes. And this technological superiority is directly translating into massive contract wins.
Let's talk about those wins, because the transcript highlights two specific national security victories that really illustrate the scale of what they are achieving here.
The first one is the BEATS contract.
BEATS, BEATS, which stands for Breakthrough Engineering and Advanced Technology Solutions.
Right.
It is a $937 million contract to support the Army's modernization priorities. Almost $1 billion.
And the most crucial detail of that BEATS contract isn't just the dollar amount, it's that it is a single award contract.
Meaning they don't have to share it?
Right. Often, these massive government tech programs are awarded to a consortium of contractors who have to split the revenue and coordinate the execution. Securing nearly $1 billion as a single award means Booz Allen captured the entire program themselves.
They are the sole architect injecting their advanced engineering and AI technologies into the hands of the warfighter.
It's a huge vote of confidence from the Army.
And the second highlighted win sounds like it was pulled directly from a science fiction novel.
Golden Dome.
They secured a highly coveted award on the Golden Dome space-based missile interceptor program. We are literally talking about the bleeding edge of national defense here, developing the prototype systems required to track and intercept hypersonic threats from low Earth orbit.
The sheer computational processing power required to calculate intercept trajectories in space is just staggering.
But, for the retail investor evaluating the stock, the most significant aspect of the Golden Dome win is not actually the space technology itself.
No, it's the procurement mechanism they used to award it.
The CEO emphasized in his opening remarks that Booz Allen experienced a nearly 90% increase in OTA proposal submissions, resulting in a 50% increase in actual OTA awards compared to the prior year.
And understanding OTAs is fundamental to understanding their entire margin expansion thesis.
Let's break this down meticulously because this is the core of it. OTA stands for Other Transaction Authority.
Yes.
To understand why an OTA is so revolutionary, we have to look at the traditional method of government procurement, which is governed by the FAR, the Federal Acquisition Regulation.
The FAR, it's legendary for all the wrong reasons.
Right. The FAR is this sprawling, archaic set of rules designed basically during the Cold War. It was built to prevent corruption and ensure fairness when the Pentagon was buying, aircraft carriers or millions of pairs of combat boots.
Commodities, things you can easily count.
Exactly. So the FAR requires exhaustive requirements gathering, years of proposal writing, massive cost accounting audits, and lengthy periods where losing bidders can legally protest the award, freezing the entire project.
It is notoriously bureaucratic. I mean, if the Pentagon tries to buy an artificial intelligence platform using the FAR, the process takes 3 to 5 years.
And by the time the software is finally installed,
the underlying code is completely obsolete. Exactly. Silicon Valley historically refused to work with the Department of Defense precisely because the FIR process was too toxic to their fast-paced business models.
Well, Congress finally recognized this systemic vulnerability. I mean, in an era where cyber threats evolve weekly, a 3-year procurement cycle is a massive national security liability.
Right.
So they expanded the use of Other Transaction Authority. An OTA allows the government to legally bypass the massive red tape of the FAR.
It's basically a fast pass.
Yes. It permits the Pentagon to operate much more like a commercial tech, giant funding, rapid prototyping, engaging directly with non-traditional tech firms and moving at the actual speed of commercial innovation.
And that 50% increase in OTA awards for Booz Allen is the catalyst for their profitability, because OTAs are fundamentally linked to a broader structural shift away from cost-plus contracting and toward fixed-price or outcome-based contracting.
This right here is the very heart of the Booz Allen financial thesis for investors. Let's explain cost-plus really quick.
Okay, so in a traditional cost-plus contract, the government agrees to reimburse a contractor for all the allowable costs they incur while doing a job, plus a guaranteed percentage fee on top of that as profit.
So if the government wants a new database built, and it takes the contractor 1,000 hours of labor to build it,
the government pays for the 1,000 hours plus, say, an 8% profit margin.
But the perverse incentive of a cost-plus contract is that it structurally rewards inefficiency.
It does.
Because if the contractor finds a brilliant way to build the database in 100 hours instead of 1,000, their gross revenue drops by 90% and their total profit dollars drop by 90% too.
Right. There is absolutely no financial incentive to deploy labor-saving technology under cost-plus. You want things to take longer.
That brings us to fixed price, outcome-based contracts, which is what these OTAs use. Under this structure, the government says, we will pay you exactly $10 million to deliver a secure, functioning database. We do not care if it takes you 1 million hours or 10 minutes.
So the risk shifts entirely to the contractor.
Right. If it takes them $15 million worth of labor to build it, They lose $5 million. They eat the loss.
If they possess proprietary agentic AI tools that can write the code and secure the database for a total internal cost of, say, $2 million.
They pocket the $8 million difference as pure profit.
Exactly.
The top-line revenue recognized is just the $10 million flat fee, so it might look smaller on the balance sheet than a sprawling multi-year cost-plus labor contract. But the margin profile is completely transformed.
And CEO Horacio Rosansky addressed this exact dynamic directly on the call. He stated, quote, "Customers, when they pay for an outcome, give us a lot more flexibility in terms of how we bring technology inside a program. And so that's where you begin to see this divergence."
Divergence between revenue and profit.
Right. He is actively educating Wall Street here. He's saying, do not panic when our top-line revenue growth stalls, because our shift toward these fixed-price tech deployments guarantees that our profit growth will vastly outpace our revenue growth.
And the financial results completely vindicate that strategy. I mean, for the fiscal year, Booz Allen generated an exceptionally robust $951 million in free cash flow.
Nearly $1 billion in pure, unencumbered cash generated from operations.
Which is wild. But for retail investors, analyzing how management allocates that free cash flow is paramount. Are they hoarding it? Are they squandering it on terrible acquisitions? Or are they returning it to shareholders?
CFO Troy Lahr provided a really detailed breakdown of their capital allocation. They deployed a total of $1.1 billion through a combination of strategic investments, dividends, and share repurchases.
Okay.
In the fourth quarter alone, they deployed $366 million. But crucially, $219 million of that went into strategic investments through their venture capital arm, Booz Allen Ventures.
Which is super interesting because it is highly unusual for a government contractor to operate a dedicated venture capital arm.
It really is.
They are effectively acting as a defense-focused VC fund, taking equity stakes in emerging tech startups. This allows them to secure exclusive access to cutting-edge tools, like the DeFi security acquisition we talked about, without having to spend years trying to build everything from scratch internally.
It accelerates their speed to market exponentially. And alongside that $219 million in venture investments, they returned $147 million directly to shareholders via dividends and stock buybacks just in Q4.
But despite this really aggressive pace of capital deployment, they still exited the fiscal year with an incredibly strong balance sheet. $728 million in cash on hand, and a net leverage ratio of 2.6 times adjusted EBITDA.
Yeah, and a 2.6 leverage ratio is very conservative, especially for a company whose revenue is basically backed by the sovereign credit of the United States government.
Yeah, they aren't going to stiff you on the bill.
Right. The CFO explicitly stated this gives them the, quote, operational and strategic flexibility to drive growth through both organic and inorganic investments.
So in plain English, they have a massive war chest ready to buy more AI and cyber companies the exact moment they see a strategic fit.
Exactly. So the story of fiscal year 2026 is one of aggressive, successful metamorphosis. They absorbed that brutal 23% hit to their legacy civil business, but they utilized that disruption as cover to accelerate the shedding of low-margin headcount and pivot violently toward high-margin, fixed-price defense tech.
Right. But, the stock market is a forward-looking mechanism. Investors care about the next 12 months, not the last 12.
Always.
And that requires us to meticulously unpack management's guidance for fiscal year 2027. Because this is the section of the transcript that definitely caused some hesitation among analysts, and it demands careful interpretation.
It was a tricky guide.
Yeah. CFO Troy Lahr projected FY27 top-line revenue to fall between $11.2 billion and $11.7 billion. Given that FY26 revenue is exactly $11.2 billion, management is essentially guiding for 0 to 4% growth.
They're basically telling investors to expect a perfectly flat top line.
Which isn't very exciting.
No. And the flat guidance is a direct result of that bifurcation we discussed earlier, persisting into the new year. Management expects the civil business to continue declining in the high single digits throughout all of FY27.
Because they still have to work through the remainder of the painful year-over-year comparisons caused by that PTEMS roll-off.
Exactly. And the structural shift toward the smaller civil contracts, the civil anchor is still heavy.
Conversely, they project the national security portfolio will grow in the mid-single digits. So the engine is pulling forward, the anchor is dragging backward, And the net mathematical result is basically zero top-line velocity.
Right.
And honestly, I can accept a flat revenue guide if the underlying profit margins are expanding.
Yeah.
But the EPS guidance is where the math gets incredibly murky.
Yeah, the profit guidance appears highly contradictory on the surface. They just posted an adjusted EPS of $6.51 for FY26, yet they guided for an adjusted EPS range of $6 to $6.35 for FY27.
So they are explicitly projecting that their earnings per share will decline next year, which, for a company supposedly undergoing a massive margin expansion, a backward-looking profit guide triggers immediate alarm bells.
It definitely does. But this is where we really have to translate the arcane rules of corporate accounting for the retail investor, because that $6.51 figure from last year is essentially an optical illusion.
How so?
The CFO explained that the FY26 EPS actually included an 11-cent boost derived from unrealized gains within their venture portfolio.
Under current accounting rules, companies must mark their venture investments to market value every single quarter.
Right. So if Booz Allen Ventures invested $10 million in a cyber startup, and that startup later raised more money at a $20 million valuation, Booz Allen has to record a paper profit on their income statement.
Which artificially inflates their reported EPS.
Exactly. They haven't actually sold the shares. They haven't realized any actual cash. It is purely a paper game.
And when providing guidance for the coming year, responsible management teams back out those unpredictable paper profits. So they are assuming zero venture gains in their $6 to $6.35 projection to give investors a clearer view of the actual core operating business.
Right. But even if we subtract the 11 cents from the 6.51, giving us a normalized baseline of 6.40, the top end of next year's guidance is still only 6.35.
So it's still a slight drop.
It is. The remaining gap is driven by a deliberate choice regarding capital allocation. The transcript is saturated with references to increased investment in strategic R&D.
Okay, so they are taking the massive cash savings generated by firing 12% of their workforce and intentionally plowing it back into building the VLOQ suite and their agentic AI infrastructure.
Yes. They are actively sacrificing short-term optical EPS growth to fund a massive long-term technological moat.
Which, as an investor, is exactly the behavior you want to see. You want management focused on dominating the cyber landscape of 2030, not starving the R&D budget just to hit an arbitrary earnings target for the next quarter.
Absolutely. The CEO stated that investment is the operative word for FY27.
Now, there is one final cash flow dynamic that depresses the near-term guidance, right?
Yeah.
Management provided a free cash flow guide of $825 million to $925 million for FY27. Given they just generated $951 million, projecting a declining cash flow also requires an explanation.
The CFO noted two specific culprits for that. First, increased capital expenditures to build out a massive new headquarters facility in Reston, Virginia.
Okay, real estate costs.
Right. And second, a significant delay involving the IRS.
Oh, right, the tax refund.
Yeah.
The company was expecting a $170 million tax refund from the IRS, but that refund has been bogged down and is now officially delayed until fiscal year 2028.
And obviously, removing a $170 million cash infusion from the current year's projections drastically alters the free cash flow guidance.
Right. And the culmination of all these factors led management to issue a very explicit warning about the timing and shape of the coming year.
Yeah. An analyst pressed the CFO on the quarterly cadence of the guidance. And the CFO bluntly stated that the first quarter will be the low point for growth.
The absolute bottom.
Yes. The civil business faces its toughest year-over-year comparisons in Q1 and Q2.
So management is basically telegraphing exactly what the headlines will look like. They were telling Wall Street, look, the first half of the year is going to look terrible on paper. Do not panic.
Right. They expect the financial momentum to steadily improve sequentially, culminating in a really strong second half.
Furthermore, the CEO layered on a crucial piece of macroeconomic context. This is a presidential election year.
Which always makes things messy.
Always. The federal contracting environment becomes notoriously volatile during election cycles. Congress routinely fails to pass comprehensive budgets, relying instead on those short-term continuing resolutions that paralyze agency spending.
Right. New program starts are delayed and contract awards are pushed to the right. So the guidance is intentionally conservative to absorb that inevitable political gridlock.
They built their projections around the most likely cases of budget delays. They're refusing to assume a smooth procurement environment.
Smart move. But amidst all the caution regarding first-half optical weakness and election year chaos, management relentlessly emphasized one metric that proves the underlying health of the enterprise.
The backlog.
The backlog. Booz Allen exited the fiscal year sitting on a total backlog of over $38 billion.
We really need to contextualize the sheer scale of $38 billion. The company generated $11.2 billion in total revenue last year. So a $38 billion backlog means they currently possess over 3 full years of total corporate revenue, completely locked in, legally awarded, and just waiting to be executed.
It's massive. And even while the top-line revenue was shrinking last year, the backlog actually grew by 3% year over year.
Which is a great sign. And the metric that drives that backlog growth is the book-to-bill ratio.
Right.
Their trailing 12-month book-to-bill ratio was 1.1 times. This is the vital sign of any service business. It measures the ratio of new orders received to services billed and completed.
So a ratio of exactly 1.0 means the company is simply replacing the work it finishes.
Right, running in place.
A ratio above 1.0 means the total pipeline is actively expanding.
Exactly. So a 1.1 ratio signifies that for every single dollar of work Booz Allen completed and billed last year, they successfully booked $1.10 in new future contracts.
And the CFO added an intriguing detail regarding that ratio, too. There is currently a massive new award stuck in the protest phase.
Oh, protests. We should explain that.
Right. In government contracting, when a massive bid is awarded, the losing competitors routinely file formal protests with the Government Accountability Office, arguing the evaluation was flawed.
Basically suing because they lost.
Pretty much. And this legally freezes the contract. The CFO noted that if they actually included that protested award in their calculations, the book-to-bill ratio would have been nearly 1.2 times.
Wow. So there was an immense amount of latent financial demand building up like water behind a dam. The government is awarding them the high-margin tech work. The funding just hasn't fully cleared the bureaucratic hurdles to be recognized as active revenue yet.
Exactly. The COO corroborated this too, stating the current award environment is exceptionally strong, the pace of procurement is accelerating, and they are seeing massive demand signals for their AI-assisted software development.
So the fundamental narrative is clear. This is a corporation executing a massive, painful, but ultimately totally necessary pivot. The legacy body shop business is shrinking, driving top-line weakness, but the high-tech, fixed-price defense business is booming, driving margin expansion.
Yep. They are dropping headcount, accelerating R&D, deploying venture capital, and sitting on a $38 billion safety net.
Okay. We have dissected the headline paradox, we've analyzed the structural shift from cost-plus to fixed-price via OTAs, and we translated the conservative, investment-heavy guidance.
We covered a lot of ground.
It is time for the ultimate talk ticker's bottom line. I need the final verdict on the Booz Allen Hamilton setup. Is this stock currently a bullish or bearish proposition for the retail investor listening right now?
Well, the verdict requires bifurcating the timeline, much like a company itself. I hold a distinctly bullish perspective for the long term, coupled with a strict caution or hold warning for the immediate short term.
Okay, detail the mechanics of the short-term caution. Why should an investor hesitate right now?
The hesitation is entirely driven by the optics of the next 2 quarters. Management has been painfully transparent. Q1 and Q2 of fiscal year 2027 are going to look incredibly weak on paper.
Because of the civil business.
Exactly. The civil business will continue to post brutal year-over-year declines as they work through those PTEMS comps. Computer-driven trading algorithms and surface-level retail traders who only scan for top-line revenue growth will see those negative headlines and likely trigger sell-offs.
They won't look at the margins.
Right. The stock is highly susceptible to severe volatility as the market digests the ugly first half.
So if an investor is looking for a quick, 3-month swing trade to capture immediate upside, BAH is likely going to be a bumpy, frustrating ride.
Yeah.
The optical narrative is simply too heavy.
However, if you look under the hood and understand the mechanics we've discussed today, the underlying foundation is ironclad. This is not a legacy company slowly bleeding out to obsolescence. This is a company actively managing its own metamorphosis.
Yeah.
The transition from a low-margin hourly labor contractor into a high-margin sauce-driven AI and cyber tech provider is structurally sound and actively working.
The 50 basis point margin expansion proves it.
Exactly. The 12% headcount reduction paired with rising revenue per employee proves it. The massive influx of fixed-price OTA contracts proves it.
They are essentially ripping out the old plumbing and installing a state-of-the-art operating system while the building is still fully occupied.
Exactly. And the $38 billion backlog is the ultimate validation that the Pentagon is actually buying what they are building. The geopolitical tensions driving the necessity for agentic AI defense systems, space-based interceptors, and zero-trust architecture, these are permanent fixtures of the modern era.
Yeah, that demand isn't going away.
No. The demand for these specific technologies will only accelerate, regardless of the political outcomes in Washington. Booz Allen has positioned itself exactly at the choke point, where national security requirements intersect with advanced commercial technology.
Let's convert this analysis into actionable advice for the listener. Based on the data, what is the specific playbook for managing this stock?
First, if you already hold the stock in your portfolio, mentally prepare for immediate volatility. When the Q1 and Q2 numbers are released, the financial press will likely focus entirely on the top-line revenue contraction.
Which we know is coming.
Right. Do not panic sell into that weakness. Management has explicitly telegraphed this exact scenario. You are holding a highly profitable company with 3 years of guaranteed revenue locked in the backlog, and they are actively expanding their profit margins. Hold your position and look past the short-term optical noise.
And what is the playbook for a listener who currently has no position, but is considering buying the stock based on this technological pivot?
If you are looking to initiate a position, keep your capital dry for the moment. Use the anticipated choppiness of the first half as your advantage. Look for entry points during the dips when the algorithms predictably panic over the flat revenue quarters.
By the fear.
Exactly. The massive payoff for this equity lies in their integration of agentic AI and space-based defense tech, which will begin driving outsized margin growth in FY28 and beyond once the civil drag dissipates. You are buying the completed transformation, not the current quarter's messy transition.
That is the quintessential talk ticker strategy right there. Understand the accounting mechanisms behind the headlines, anticipate the algorithmic overreactions, and buy the underlying structural strength. Look for the dips caused by flat revenue, knowing the profit engine underneath is just revving up.
Because they possess the fortress balance sheet necessary to weather the election year budget storms, they operate a venture arm capable of capturing bleeding-edge tech, and they hold the entrenched classified government relationships required to deploy that tech at a global scale.
As we conclude this deep dive into Booz Allen Hamilton's incredibly complex Q4 earnings, I want to leave you, the listener, with a final provocative thought. Something to analyze that builds on the technological disruption we've uncovered today.
Oh, this should be good.
We spent significant time detailing how Booz Allen is heavily investing in agentic AI to autonomously execute complex cyber defense tasks. They're actively building software designed to replicate the work of human analysts, executing it faster, cheaper, and autonomously under highly profitable, fixed-price contracts.
Right. And the deployment of that agentic AI is the core driver of their margin expansion thesis.
But analyze the ultimate logical conclusion of that strategy. Booz Allen Hamilton was built, over more than a century, entirely on a human consulting model.
True.
The foundational bedrock of the firm is an army of highly educated humans billing their time. So if their proprietary agentic AI becomes so advanced, so flawlessly autonomous, that it can literally replace the analytical capabilities of thousands of their own human employees, does the technology eventually cannibalize the very foundation that built the corporation in the first place?
Man, it is the absolute definition of the innovator's dilemma playing out in real time.
Exactly. They are engaged in a desperate race to ruthlessly disrupt their own business model before a nimble, unencumbered Silicon Valley startup does it to them. They are intentionally burning their legacy ships to construct a new digital fleet. The existential question is, will they succeed in completely rewiring their corporate DNA? Or will the friction of the transition destroy the host in the process? It is a high-stakes, multi-billion-dollar gamble, and it is going to be utterly fascinating to track its execution over the coming quarters.
How they manage that internal cannibalization will absolutely be the defining narrative dictating the stock's performance for the next decade.
And we will be right here dissecting the data every step of the way. Thank you for joining us on this special Talk Tickers deep dive. Remember to always look past the headline numbers, demand to understand the mechanics behind the margins, keep questioning the consensus narrative, and we'll see you next time as we wade back into the data.